Hi, everyone. Thanks for joining us this afternoon for our first live webinar. We appreciate your time. 2020 has been quite an interesting year so far. We're only 10 months into the year. The financial markets have been on a roller coaster. We're still fighting this global pandemic that has forced us into this virtual world, whether we like it or not. And we still have this presidential election in a few weeks. So our team has been studying the policies, the potential policies under each candidate and how it may affect your financial plan and investment portfolio. And we want to share our insight with you today. But before we get started, just a couple of housekeeping items. First and most important, I'd like to introduce you to Matt Callahan. Matt is the newest member of our Seaside team. Many of you have had the chance to speak with Matt, but this is good to put a face to a name finally. So
I'm looking forward to meeting everyone in person, but video is okay for right now.
Exactly. We're forced here. The second thing is all participants today on the call are going to be in listen-only mode. And then at the end of our prepared remarks, we're going to have a session for question and answers. So if you'd like to submit a question, you can do so at any time during the presentation by using the question and answer feature at the bottom of your screen. And you could just type in your question and we'll read it out loud and answer it live. If we don't get to all the questions today, we'll follow up with you directly afterwards. And then lastly, we are going to be recording this webinar and we'll post it to the blog section of our website, www.seasidewealth.com. So without further ado, I'm going to hand it over to Brad.
Thanks, Tina. I appreciate that. And boy, it sure would be nice to be seeing all of your shining faces today and shaking hands and giving hugs and having a drink or a snack together. But you know what? 2020 is not to be. So our hope is that next year we're on to brighter days and hopefully we can do these events in person. But we really believe that a big part of our job and the role that we want to play in your life is to educate and empower you around your finances, your investments, and your planning. And really all the goal is to help you create peace around the issue of money. And we feel like educational events like this are a big part of what we do. The more that you can understand what's happening with your money and your investments, I think the more successful outcome you're going to have and the better you're going to feel as well. So tonight, we've broken this up into really three parts. First part is where have we been? The second part is where are we now? And the third part is where are we going? And so to take a look at where we've been, it was not that long ago that the market, this was March of this year, the market was in free fall. We had one of the worst first quarters in history. The S&P 500 was down 34%. What's interesting to note is that this was the fastest descent into bear market territory in history, 22 trading days. And so we had very negative headlines and one of the worst first quarters ever, and 3,000 point declines. And it was a very uncertain and kind of scary time. And so what did investors do? Well, we can see that people were selling everything in March. So the market bottomed on March 23rd of this year. People were selling stocks, bonds, anything they could get their hands on, they were selling. And then what did they continue to do through April, May, June, and July? They started to nibble back into the bond market, which actually, incidentally, the bond market went up, bonds were going up. And so people were buying into the asset class that was going up and stocks went down. And what were people doing in April, May, June, and July? They were selling stocks. And we all know that we should buy low and sell high, but sadly, the average person did just the opposite. And so, and fortunately for all of you, nobody here did that, thank goodness. But what if you did? You would have missed the best 50 days ever in the stock market. It started in April and then the market went on a tear. And this was the best second quarter that we've had since 1957. And had you gone to cash and given into that temptation, you would have completely missed it. And what's interesting is we've got really a historical lesson in such a short period of time. Market took 22 trading days to get into bear market territory, and then just went on a tear out of it. It's just a great reminder. You cannot time it because it moves too fast. So where are we now? Well, we're about 3 weeks away from a very contentious presidential election, and we're still in the middle of a pandemic, and there's uncertainties looming everywhere. So we've taken the time on your behalf to just kind of study what's happening today and really kind of applying some historical lessons that we've learned from the past and to help determine what's the best course of action now. And so, of course, a bitterly contested election. And, I want to remind you, this is a quote, and the economic consequences of a Donald Trump win would be severe. And the timing of this quote was back in 2016. And the only reason I bring this up, this is not a political comment. It's just simply to show that at that point in time, the consensus was that Hillary Clinton was going to be the next president of the United States, and that a Trump victory would be very bad for the market and the economy. And of course, on election night, the futures market was down 1,000 points. And that didn't even last the first day. The market closed up and then went on to post 15 straight months of positive advancement after the election. And we've never seen that before. And so the point here is that oftentimes the general consensus can be wrong. And it's also it's important to remember that while we may be passionate about our political feelings, we don't want to let our politics drive our decision-making process when it comes to investments and money. Let me show you what I mean. This is a chart going back the last 20 years showing you how people of different political parties feel about economic conditions. And so the red would be Republicans. And of course, during the 2000s, when they had a Republican president, the Republicans were happy and they thought that the economic conditions were good during the 2000s. Then, of course, that fell off a cliff in 2008, and sentiment stayed very, very low all the way until 2017, which incidentally correlates to when President Obama was elected in 2008 and then Trump in 2016. And so it shows just the opposite for Democrats. They were relatively unhappy during the George W. Bush era of the 2000s, and then gradually started to feel a little bit better about economic conditions through the Obama presidency. And then during the Trump years, that's gone back down. And so again, the point of this is simply to show that it's very easy to look at the world through the lens that we want to see it through. And the danger is we cannot let our political leanings drive our investment process. Here's why. If you only invested during the presidential election term of your party's president, things would not have gone so well. And so let me show you what we're talking about. This is since 1961. If you had invested only during a Republican president, $10,000 in 1961 turned into about $86,000 at the end of last year. If you had invested only during a Democrat president, then $10,000 would have turned into $376,000. But if you remained invested through both parties, $10,000 turned into $3,248,612. And so, again, kind of illustrating the point of why it's important to try and separate your politics from your investing, as difficult as that can be. And so looking back at all the presidential terms going back to 1929, the market has averaged 10.3% per year. And would you really care if that 10.3% came under a Republican or a Democrat president? And so it's just a good reminder that while it's definitely hard to separate your politics from your investing, it's important. What about the international markets? What we found was that since 1973, there's only been three presidential terms that were negative, and all three of those came under Republican presidents. What we found in the emerging markets was that since 1989, there have been 2 time periods of negative returns, and those came under Democrat presidents. And so what we found was that who the president of the United States was really didn't drive this as much as one might think. It was really driven more by trade imbalances, tariffs, currency exchange, things like that. And so kind of interesting to look at that. When it comes to the bond market, we found that there has never been a negative 4-year period under any president since 1977. We do find ourselves in a very interesting time when it comes to the bond market. Interest rates are at all-time lows, but it's good to know, and we saw this in March, that bonds continue to play the role of buffer and cushion in the portfolio. When stocks were going down in March, bonds were going up, and long-dated treasuries were doing fantastic. And that's exactly the role that we want bonds to play in the portfolio. And so what you would have expected in the bond market is exactly what played out, and that's good to know. We are getting questions around, okay, what does a victory mean? For each of the political candidates, to presidential candidates, and so we're getting questions. Okay, if Biden wins, what does that mean? And what we do know is that today, corporate tax rates in the U.S. Are certainly at some of their lowest places that they've been in a long time. It wasn't that long ago that the U.S. corporate tax rate was 35% or north of 35%. President Biden has said that he would like to increase the corporate tax rate. His proposal is 28%, so certainly higher than the 21% we're at today, but certainly nowhere near where we were in the 90s, north of 35%. Other changes that we do see here and read about would be increases on income tax rates for high income earners, potential changes to the step up in basis rule, and there's some other estate planning changes that could happen as well. So we're keeping our eyes on this and watching it very, very carefully. What it does highlight, though, is the opportunity right now today for Roth conversions. And this strategy doesn't apply to everybody, but when appropriate, this can save people hundreds of thousands of dollars in taxes. And then, of course, a Trump victory means that we will have the Tax Cuts and Job Act, which was put into place in 2017. It will sunset in 2026. So it buys you several more years of this window where you can consider doing Roth conversions. We really believe that whether it's next year or 4 years later or somewhere down the road, tax rates will be going up. And so we should all be planning for that, which makes the value of doing Roth conversions today, or even Roth contributions, if appropriate, it makes it really valuable. So we see significant savings. If it works appropriately, we think that you can save a lot of money in taxes by taking advantage of that. So if you're sitting there and you're thinking, yeah, okay, but this election, this time, this just feels different. We've never seen anything like this in my lifetime. If you're feeling that this time is different, we would argue you're right. In fact, we would even say that every time is different. And what we mean by that is there have been so many shocks to the system throughout time, and those shocks to the world, to the economy, to the markets definitely send ripple effects through the markets. But the market and the wonderful companies that you invest in do an incredible job of processing that information and figuring out how to get through. And I'll just kind of highlight a couple that we've seen in the last 50 years. We had Brexit in 2016. We had the financial crisis of 2008. We had the dot-com boom and bust of the late 90s and into 2000. Of course, who can forget the Y2K scare, 99, 2000. We had Black Monday in 1987 on my birthday. The Dow was down 23% in one day. And then, of course, Business Week declares the death of equities in 1979. And of course, who could forget the inflation and stagflation and high interest rates? So we've had shocks to the system before, and every single time that we get a shock to the system, it is going to be different. I would say the good news is this. We know that there will be continuous shocks to the system. And we also know that your portfolio is built to weather the shocks to the system. We're not chasing after fads. We're using discipline to construct a portfolio that's designed to weather no matter what may come its way. And so that is a little comforting, especially as you look at what's happened over the last 50 years. For most of you this evening, you're going to have another 20 to 40 years ahead of you where you're going to see shocks to the system. And so we would say prepare for it. But the volatility that ensues, the volatility is simply the fee that you must pay to achieve the wonderful long-term results that owning great companies delivers. And so as we take a look at almost 100 years of market data, we see that the market has done really well. And it's good to know that the market is bigger than one person and one party. But if you're still not convinced and you're thinking, well, maybe I'll take a little bit of my money and go to cash, it's just very uncertain. I'm going to sit this out. I'm going to wait until we get some certainty or clarity, at least post-election in November. I'll invest back in. There's a real danger in that approach. And the danger is if you were simply to remain invested over the last 30 years, your long-term returns would have been very close to 10% per year. But if you took your money out of the market and you missed just the best single day, one day in a 30-year period, your returns were reduced by almost 0.5% per year. If you missed the best 5 days, your returns were 1.5% per year less than they would have been. And of course, if you missed the best 25 days, your returns would have been cut in half. And the reason why, and why no one can do this consistently, is you've got to get it right twice. You have to time when you get out and when you get back in. And we've met some people that can do one of the two accurately, but we've not met anybody who can consistently get it right twice. But again, our job is to be constantly on the lookout. And the day that we meet the person or the institution or company that can do it, you better believe we will bring that solution to you. But for now, we would discourage you from trying to do that because it just has not proven to work well. I think the silver lining in this, though, is that no matter who wins, I think that historically, at least over the last 100 years, when a new president is elected, the stock market has responded on average with a 9.3% return. The bond market has done 6.7%, although we wouldn't anticipate bonds to do 6.7% next year with interest rates as low as they are. But it is interesting to look at that. And then when the incumbent president wins, the market has averaged 13.4% in stocks, and then bonds 4.2%. So whether it's 9 or 13%, I'm certain anybody on the call tonight would be happy with a return like that. So just keep that in mind. And the other thing to keep in mind is, and maybe the good news or the better news is, we're not investing in political parties. We're not investing in politicians, thank goodness. We're investing in great companies, okay? Now, speaking of great companies, I want to transition and talk a little bit about the S&P 5. I mean, the S&P 500. What do I mean by that? What I mean is there are 5 companies in the US that are really driving a lot of the action in the S&P 500 this year. You've got Facebook, Apple, Amazon, Microsoft, Google that are just really doing well. And I think they're doing well because the pandemic, as we all, people are working from home, they're staying from home, and technology, everything is tech driven. So this work from home environment, which is really fueled by technology, it makes sense that these companies would do really well. And as a result, what we see happening is that these companies now represent a much larger portion of the index than they ever have. And so back in 2014, those 5 companies represented 9% of the S&P 500. At the end of 2019, those 5 companies represented 17% of the index. And now today, they've gotten so big, they've done so well that they represent a quarter of the index. And so there's real danger in that, because you think you're diversified by you think you own 500, you do own 500 companies, but when 5 companies represent such a large portion of the index, there is real risk when that happens. Because should something happen to any one of those 5 companies, it can have devastating effects on the overall index. Take a look at this. Those 5 companies are responsible. Those 5 companies have a 49% return this year, 49%. So on the whole, the S&P 500 index is up 10% this year. It is really fueled by those 5 companies that are driving everything. The other 495 companies in the index combined are down 3%. And so why I bring this up is it's the old, it's the old FOMO, the fear of missing out. And it's really tempting, especially when you're hearing, oh, the market's recovered, or your neighbor might be saying, yeah, my portfolio's in positive territory. Oh, market's recovered. It's really important to understand what's going on. And so it's tempting to ask, well, I've got this globally diversified portfolio with 9 different asset classes, and it's underwater slightly for the year. And here the market's recovered. Something must be wrong. Something must be broken. And when you look at history, you see that this is actually very normal. What's not normal is how fast the S&P 500 has recovered, and the fact that we have such concentration risk. So all this performance is driven by just 5 companies. And it leads to the wonderful question that we get asked, which is, well, would this be a good time to maybe buy some more of those companies? Should we invest? Should we buy Amazon, Apple, Netflix, Google, Microsoft? Should we? And we see that this phenomenon of 5 companies representing such a large portion of the index, this is nothing new. This has happened before. And so we wanted to study, once companies represent such a large portion of the index, how do they do the following 3, 5, and 10 years after? And what we found was interesting. On average, when companies represent a major portion of the index, they're flat for the following 3 years. They're actually down 1.1% per year for the following 5 years. And then they're down 1.5% per year for the decade following when they get that big. And so if you're tempted to want to go out and buy those individual companies, the data would tell you, just take caution, be careful, because this is usually the time when things can go wrong. And the reason why is that they're so popular, they've really been bid up in price. And we all know we want to buy low and sell high, and buying now would be the opposite. You'd be buying high. The other interesting thing to note is this is not the first time this has happened. And I'm going to take you down a brief trip down memory lane. Back in the 30s, AT&T represented a major portion of the index. And what we see when we study this is that the companies that end up at the top of the market in terms of market share are typically innovators. They're disruptors. And that's exactly what you see with Apple, Amazon, Microsoft. They've come in and they've not only changed their industry, but they've changed the world. And this phenomenon, while it looks and feels different today, it's actually nothing new. So AT&T brought us, cellular technology, and they were at the top for many, many years. There was General Motors and General Electric that were ranked in the top 10 for decades. IBM and Exxon were also mainstays in the second half of the 20th century. And DuPont, inventor of Teflon and nylon, was another company that was like this many, many years ago. So to see this type of concentration in the hands of just a few companies, it is nothing new. And so it is important to take heed and not to really go after it or get greedy at this point in time. And here's why. So the last time this happened, at least in the S&P 500, was the late 90s. We all remember the dot-com bubble. And so what happened in the 10 years following the dot-com bubble? The S&P 500 lost a total of 9% over 10 years, almost 1% per year for an entire 10 years. Meanwhile, the other asset classes that you all own in your portfolio did fantastic, so that a globally diversified portfolio was in positive territory and helping you move towards your goals in the 2000s. And meanwhile, the S&P 500 lost money for 10 years straight. And so as we study this, we're asking ourselves, okay, is what's happening today, can we draw any lessons from history? And really, is what's happening today, is it normal, or what should we be thinking about this? What we've seen is that since the Depression, we've had 14 bear markets, and a bear market is defined as a decline in our US market of 20% or more. So we've had 14 of them. And oftentimes they are just death-defying, almost feeling like a fall off of a cliff. They can be scary. They can be full of uncertainty. And as we study them, we see that the average bear market decline is actually 30% down. The average length of a bear market is a year, and the average time after it hits the bottom to recovery is 2 years. So from the peak to the trough back to the peak again, typically takes 3 years. So the asset classes in the portfolio today, some of them are underwater still and they're still in recovery mode. We hit the bottom March 23rd of this year, barely 7 months ago. So the behavior of the asset classes is really normal. What's not normal is how fast the S&P recovered. But what we see as we look under the hood is it wasn't driven by the entire index. It was just driven by 5 companies that have really benefited from what's happened or what continues to happen with COVID. So kind of interesting. Okay, I think what's important to take a look at is where are we going from here? And so it's good to know, despite what it might feel, we are in the early stages of a recovery. And we're still in a recession, but we are in the early stages. And so here's some interesting data points that you don't hear often, but you should be aware of. TSA screened nearly 1 million travelers on September 4th. This was the most people traveling since March 17th. And while the airline industry is still down 50% from a year ago, it's up tenfold from the lows in April. Manufacturing is starting to expand again. Small businesses are hiring, and the unemployment rate has dipped below double digits for the first time in a long time. And so what tends to happen during the early stages of recovery? We see asset classes like small companies, small cap, and value really begin to turn it on and shine. And what's interesting is that small cap value this month, the month of October, is up 10% for the month. And while it's too early to tell if this is going to be a prolonged rally, it's certainly something that we would expect and historically has happened throughout time. So this behavior is actually really normal. And then the other asset class, of course, is value. And so speaking of value, this is really the highlight here. What you're looking at, so we've seen growth companies, large cap growth, outperform value by over 8% per year for the last decade. And what you're looking at here is the returns of growth relative to value. So right now, growth has outperformed value by 8% per year for the last 10 years. This is the widest dispersion in history. And it's on par with the dot-com bubble back at the late 90s, 2000s. Same thing happened. And it's also on par with 1939, right before World War II and right after the Depression. And so it's interesting to note because people are asking the question, well, what tends to happen after we see growth do this well? And they also ask, is something wrong with value? And we studied this and we saw that, nothing's wrong with value. The 10-year return on large cap value is right around its long-term average of 10% per year. The real story is that growth has outperformed its long-term average by nearly double. US large growth has compounded at 19% per year for the last 10 years. And so we just remind you that the name of the game is buy low and sell high. This is the time to be selling US large growth, take your profits and buy low into the things that are on sale. Small cap, value, emerging markets. We'll touch upon that later. But what's interesting is throughout history, the 2 other times that we've experienced a decade like the one we just came out of, where growth outperformed value, in the 30s, growth outperformed value by 4.9% per year. The following 10 years, value turned it around and outperformed growth by 10.3% per year. How about the 90s? Growth outperformed value by 3.1% per year. The following decade, value turned it around and outperformed growth by 6.4% per year. And while nobody knows for sure what the future will hold, history tells us that this is not the time to go chasing growth. And it's also not the time to give up on value, because at some point the tide will turn. It is important to maintain both in your portfolio and stay diversified. The other story that we see that's not really talked about much, but we see it, is in emerging markets. And you're looking at a similar chart And this is showing you that the performance of the emerging markets relative to US large companies. And we see that over the last 10 years, emerging markets have underperformed big US companies by over 10% per year. Now, what's interesting is this has happened before. And we studied, well, what happened the following 10 years after there was a lag in performance like the one we've just seen. And the good news is that the emerging markets, they came roaring back and they outperformed big US companies by nearly 4% per year. And the other interesting thing is emerging markets and international companies tend to do better when the US dollar is softening or soft. And the reason why is you're bringing international profits back home. And if you're bringing them back home into a currency or a US dollar that's getting weaker, it's like an accelerator, or it multiplies it exponentially. And so when you look at what's happened with the massive amount of stimulus that's been pumped into the economy, we are seeing that start to happen where the US dollar is softening. And so this could definitely be a boon for emerging markets. And we could be in the early phases of the emerging market rebound. Okay, well, I want to leave you with a little bit of good cheer and some good news. So if you're out there and you are still not feeling better, if you're thinking that things are pretty bad, you know, the election's right around the corner and it's rough. We're in the middle of a pandemic. There's social unrest. This is a really challenging time. We are so divided as a country. I'll leave you with some good news. The good news is that right now, the sentiment in the country, only 13% of people think that that things are going well in the United States. Now we've been this low before, and I'll take you back to December of 2008, right in the middle of the financial crisis. 1992, the savings and loan crisis and the recession of the early 90s, satisfaction was this low. And in the late 70s, with high inflation rates, high interest rates, stagflation, the sentiment was this low as well. And the good news is that each time following periods where people feel this lousy about things, the good news is that the US stock market has responded really well. So the irony is that sentiment, or how we feel about things, is actually a contrarian indicator. The market actually responds better than one might suspect when feelings are this bad about how things are going. So I just remind you the importance of really controlling what you can, because so many things are out of our control. And so, you know, financial planning is a process, not an endpoint. It's a journey, and we want to help you move towards your goals, but you've got to concentrate on those long-term goals and objectives. And it's so easy to get sidetracked by the noise and get distracted and start to make decisions that are not good to your financial health. You've got to focus on reaching your goals, not on beating benchmarks, because if you're focusing on beating benchmarks, you're going to start to chase after it at the very wrong time that you should be chasing after things. You need to maintain a disciplined approach in good and bad markets. Market timing just does not work. And the day that changes, we will let you know and we will change. But for now, no one has proven they can consistently do it. You must remain broadly and globally diversified, and asset allocation is key. That's going to drive 95% of your success. You got to reduce your investment in tax costs where possible. And that's where we focus on using very low cost investments that are tax efficient and have low turnover, and rebalance as necessary. And that's where we work very hard to make sure that we are consistently rebalancing through markets, managing through markets, not to them, tax loss harvesting where appropriate, and keeping you aligned, keeping your portfolio aligned with your long-term goals. So I know that there is a lot going on in the world, and I know that it's not easy to maintain that long-term focus, but I want to open it up for questions and see what's on your mind at this point in time.
Thanks, Brad. That was a lot of information, very insightful. You have a way of just always making me feel better at the end of your comments, so thanks for that. We did have a few really great questions that came in, and I'm going to start with one that is about asset allocation. And I'm just going to read the question just as it's written, because it's really, really good. And we've been asked this by several clients, so I wanted to just touch on this first. So the question is, as your numbers show, it really does not matter which party is sitting in the White House. But have we ever had a more progressive agenda being pushed, which could affect the economy and obviously our investments and asset allocation?
Yeah, great question. And so there have been times, while this time may feel different, there have been times. President Wilson is one president who comes to mind who definitely had a progressive agenda, and we have seen this throughout history. And just keep in mind that the pendulum tends to swing and it tends to ebb and flow. And so we don't know exactly how this is going to play out, but there have been plenty of times like this. Although in recent memory, this is definitely unique to our generation.
So, our guidance is that if we've set the asset allocation for you based on your values and your goals, we want to keep plowing forward with our globally diversified strategy and not deviate from the path that we're on.
Yeah, I mean, maybe another way of asking the question, or the question that I've been hearing is, should we be making changes to that asset allocation based on what we're seeing? And it's a good question. It's the right question to be asking. And what we say is no, that you shouldn't make changes to your asset allocation unless your plan has changed or your life circumstances have changed. But what you should be making changes to is the relationship of the asset classes within your portfolio, and you should be taking advantage of what's going on. We've got two asset classes that are in positive territory for the year. We've got bonds and we've got US large cap growth. And so we should be trimming from those two areas, so selling high, and we should be looking to redeploy that into asset classes that are down, which would be emerging markets, large value, international value. So making adjustments, managing through markets, but not making wholesale changes to the asset allocation. Because typically what we see is when you make changes like that, you do the wrong, you chase. You would be buying emerging markets back in 2007 after they had a 5-year phenomenal run, kind of like what US large growth has just done over the last 5 years. Emerging markets did the same thing in the 2000s. What happened to emerging markets after they went on that run? Well, they lost 53% in 2008 and then went on to post a pretty miserable 10-year return. And they're starting to come back now. Meanwhile, you would have been shunning US large growth in 2009 because it basically it was a bottom dweller for 10 years. It lost money for 10 years. What did it do post 2009? It went red hot. So that's two classic examples of why you don't want to make changes to your asset allocation, but you do want to be rebalancing and take advantage of these price dislocations.
Great, thank you. I think that's a good segue into the next question that came in, which is, you talked about the S&P 5 and their phenomenal performance so far this year. Should we just be buying more of those individual companies and loading up on those and trying to capture the return?
Yeah, great question. And it's so tempting. And we get asked by people, should I buy some Apple or some Amazon or Microsoft? And I think the data is pretty clear that when companies get this large, when they represent this large a portion of the index, the upside, what do they say? The easy money's already been made. Not that there's easy money to be made, but the people have been just bidding the price up sky high. So we would recommend against chasing the performance now because they've just had a phenomenal run. If you own those companies, this would be the time to be trimming and reducing risk. And in general, we recommend against individual companies because there's an interesting statistic that you have a 47% chance of losing money by owning individual stocks. But if you must go out there and do it, we recommend choosing a dollar amount that you're comfortable completely losing. Because when you invest in individual stocks, that can happen. It's literally like going to Vegas. And so whether that's $10,000 or $20,000, come talk to us and we can help you determine what's the amount of money that if it just wasn't there next year, your plan would still be intact. And if you do want to scratch that itch, we'd say open up a little side account on the side. And if that's what you do for fun, great. I can think of probably 100 more exciting, interesting things to do for fun. And that's really why we recommend against the individual stocks. It's just very risky.
Good point. Good point. Another question came in about interest rates. And the question is when, not if, but when do we see interest rates rising?
Yeah, good question. And a quick say, Tina, you've been pounding the table for really months about if anybody has a mortgage and they haven't yet refinanced, do so now. Hang up the phone and call your mortgage broker. And if you need a referral, we can give you one. Because you're locking in an interest rate that is historically low. We'll probably never see rates like this again, this low in our lifetime. Federal Reserve Chairman Powell has said pretty clearly that the next 2 years they're planning on keeping rates low. So we do have a little bit of a window here. At some point in time, they're going to start to raise them. And the way interest rates work is they move inverse or opposite to prices. So as bond interest rates go back up, bond prices will go down. And so you need to be really careful about what you own in your bond portfolio, because there could be some real misery in the bond market. And so, this is something that we watch. This certainly keeps us up at night because we want to be very, very careful with the moves we make in the bond portfolio. Because this is a real thing. When rates go back up, there is definitely risk in the bond market. So short-term high quality has definitely been good, but with rates this low, there's just very low returns. So we are exploring where does it make sense to take risk in the bond market and what risk should we just shy away from. So this is actually currently happening. Our team is engaging in this right now. So stay tuned. We'll probably have some interesting feedback for you by the end of the year or early next year.
Great. So a couple of questions came in about rebalancing, and the questions, there's a couple of them, so I'm going to kind of combine them together. But one is, if you could touch on our process for rebalancing, what triggers rebalancing, how often do we do it? What are we doing? What happens when we rebalance?
How does it work? Sure. Okay, so there's a couple of different things we're looking for. And the first one from a very, very high level is the relationship of stocks to bonds. And when we see a difference or a dislocation of 5% or more, and we've studied this, where do you put your thresholds? And if you put them too low, meaning if there's just small incremental moves, if you put those thresholds too low, then you actually give up some of your returns because you're selling too soon. But if you make those thresholds too wide, now you're opening the portfolio up for too much risk. And as we've studied this, really 5% is kind of that sweet spot. So let me explain. If your target allocation was supposed to be 65% in stocks and 35% in bonds, what was happening in March of this year is stocks had gone down. And instead of representing 65% of the portfolio, they now represented 60%. And bonds, meanwhile, had gone up. And instead of representing 35% of the portfolio, they represented 40%. So your 65-35 portfolio had turned into a 60-40 portfolio. And that's when we got the trigger. That was the time. And so, literally, I'm not kidding you. It was the market bottomed on March 23rd. And we joke, our crystal ball broke, it's irreparable. It's never coming back. But this is the way it went down. And I guess it highlights that the importance of having a disciplined process and checking your emotions at the door and just working the process, because we got the signal on March 24th. I am not kidding. The last week of March, we were doing aggressive rebalancing and aggressive tax loss harvesting. Not because, if you asked me if I thought that was the bottom, no, I didn't think it was, but it highlights no one can predict it or guess it. You just can't. But the system works. And so last week of March, we were rebalancing. And so we were selling the bonds just a little bit because now you had too many bonds in your portfolio, and we're buying stocks on sale. And now today it's come roaring back, and now stocks are starting to represent, you're slightly overweight on stocks because things have recovered. So now we're watching, and at some point down the road, we're going to trim again, and it's going to be the opposite. Once the stocks have fully recovered, we're going to sell high and then buy back into bonds. So that's the first level, is the stock to bond ratio. And then as we break it down, we're looking at US to international. So we like to have roughly 60% in the US, 40% to international. And then as you break it down further, we like to have large cap relative to small cap in both US and international, and some real estate. So on an asset class level, there's a 20% threshold. So if, for example, in plain English, if you're supposed to own, let's say 10% to US large cap, and it now represents 13%, it's gone up. There's too much, and we're going to trim a little. We're going to take it from 13 back down to 10, and we're going to look at which asset class is underrepresented in the portfolio, and we're going to buy. And so that forces you to sell high and buy low. Why it's oftentimes uncomfortable is you're selling the one thing that you love, you're getting rid of your darling, and you're buying into the one thing or things that are kind of unloved. They've not treated you well in the last 1, 3, 5 years, but you look back and you wonder, boy, how do people do so well with this? It's because they check their emotions at the door and they follow a system and a process. So that's how it works here. The beautiful thing is that technology today is incredible. And we spent a long time vetting different technology stacks, and we're really pleased with our portfolio management software. We've been with them now for over 2 years, and they're fantastic. Worked like a charm in March, and we were pleased with how it went.
Thanks. That's good. I think that gave everyone a good idea. And then, we, like Brad said, always rebalancing our software does it for us automatically, which is the wonderful thing about technology. And
I'll add one thing though. While we all love technology, we're a little bit old school in the sense that we have manual checks in place. So this is not AI driven or 100% robo driven, because we've seen it where technology can go wrong sometimes too. So there are manual checks. We have weekly checks for high cash, low cash reports, and we do put our physical eyes on the allocation as well with frequency, because I don't know, I don't want to leave anything to chance, but I think the combination of tech and then systems and processes is effective.
Definitely. Great point. Okay, another question came in. This is really good. So what does it mean when someone says the recovery is V-shaped or J-shaped? We're talking about the economic,
Yeah,
economic
good
recovery.
question. Let's see if you can still see my screen. All right, so this is how most of the recessions, the bear markets, and the recoveries look. So we peaked in February of 2020. We hit the bottom March 23rd of 2020, and then the S&P broke back into positive territory a few months ago. This looks like a V. And
I think I'm still seeing the question slide. Is everyone else still seeing the question slide?
Not seen. Okay. Well, think of it.
On it.
What's that?
I see you drawing on it.
Oh, okay. Think of it like the letter V. And most recessions, there's a steep drawdown and decline. Usually there's a bottom that's put in place. Unfortunately, many or most people have already sold out because they just can't take the decline anymore. And then the market tends to come roaring back. That's what a V-shaped recovery looks like. You get some, and all 14, most of the 14 recessions that we've had and bear markets that we've had have looked like a V-shape. A J-shape, just imagine kind of a longer, slower curve on the bottom, so kind of a prolonged period at the bottom. We've not experienced that this year, although back in March and April, that was the question. Will this be a V-shape, a J-shape, or worse, a W-shape? And I don't think it's going to be a W-shape, but imagine a V within the second half, and then basically another V to it that looks like a W. So here we are kind of clawing our way back, and we're starting to see some green shoots of economic expansion. The markets are doing better. And the fear was, and I think continues to be, will we see a second downdraft, whether that's a pre-election or post-election, who knows, to be followed by a recovery later. This is less common. It's more rare to see a W-shaped recovery. And the way things are going now, to me, it looks more like it's going to be a V-shaped. But that's, the political, the economic commentators like to talk about this. I think it gives them something to talk about.
Okay. And then you talked earlier, and this is more of a comment, just a couple of things regarding questions that came in. You talked about strategies around taking advantage of these lower tax rates and if a Roth conversion is appropriate for you. We're looking at everybody's financial plan, and if the Roth conversion is appropriate for you, we'll be reaching out to you. We look at your tax return, and we do some forward-looking projections to see if it makes sense for you. So we'll be reaching out to you. And then lastly, just another housekeeping item. We have recorded this webinar. Afterwards, in a few days, probably we'll post it to the blog section of our website, so you can access it there. If we can also send you a link and right to your email. So just let us know. And with all of that, we've answered all the questions that have come in. They were really great questions. Thank you for participating. And Brad, I'm going to let you make the closing remarks.
Yeah, absolutely. Well, it's just a pleasure to work with you and to serve you. And we certainly appreciate your business. We appreciate your relationship. We appreciate your friendship. We recognize that these are definitely unique and unusual times, and it's not easy to go through this. We also recognize that the role that we want to play in your life is, we kind of joke that, we're financial planners. We're all certified financial planners, but in a lot of ways, we are financial therapists as well. And if you're just feeling uncertain or just nauseous, downright nauseous about what's going on, don't hesitate to reach out. And that's really the role that we want to play in your life, is to guide, coach, and counsel you and help you navigate this season of your life, ultimately, so you can create peace around the issue of money. I mean, that's our real mission here. So it's an honor and a pleasure. I hope to see all of you in person next time. That would be wonderful. And until then, it will be Zooms and screen share and phone calls. But we miss all of you and hope to see you soon. Have a good evening.